Hello and welcome to this World Gold Council webinar. My name's Andrew Naylor and I'm the Regional CEO of the World Gold Council here in Singapore, and I'm delighted to be joined by my colleague and World Gold Council Chief Market Strategist, John Reade. One of the major themes of discussion at the moment is cryptocurrency, and today we're going to be exploring some of the major differences between gold and cryptocurrencies. So John, thanks for joining us. I just wanted to start by asking for you, what are the major differences between gold as an asset class and cryptocurrencies?
Well, where to begin? I mean, that's such a big topic. I guess from the first perspective, I'd say is gold has a, 5,000 year history, 6,000 year history. I think Bitcoin's been around for about 14 years now. One is a physical asset, which has been valued by society, both as an object of beauty and adornment, but also as a financial asset. I mean, gold was money for quite a while, and certainly remains at the center of the financial system. I don't think it's any coincidence, for example, that the only other asset apart from currencies that central banks can include in their international reserves is gold. So not crude oil, not copper, not iron ore, it's gold and financial assets based off currencies. That's in the international reserves. So you're talking about something very tangible. And one of the real attractions of gold to many investors is the fact that you can pick it up and feel it and see its brightness and its allure. Crypto assets are very different. They exist, I was going to say in the matrix, but that's probably the wrong analogy. They exist in the metaverse, maybe, if you want to think of it that way. They exist in electronic form only. And although you see lots of representations of Bitcoin as physical coins, I mean, that's nonsense. They're a line of computer code held in a network and referenced via a blockchain through a distributed ledger technology. Bitcoin has value. Bitcoin and the other crypto assets have value because people think they're valuable. There's no other uses for it other than within this network, within the system. So I think there's a lot of differences between the two assets. Now, there are some similarities too. And I think the similarity that most people focus upon is the engineered scarcity of Bitcoin. There's a maximum number of them that will be ever mined. And again, that's something else that terminology, which also makes it look a little bit like gold. So 21 million Bitcoins will be the most that will ever be produced. I think the last Bitcoin will be created or mined in the year 2140. And until then, we're seeing an ever slowing amount of Bitcoin coming to market, effectively. And I think at the moment, the stock of Bitcoin is growing at about 3% per annum. That compares with gold supply, which is growing at about 1.6, 1.7% per annum. If you look at newly mined gold compared to the stock of gold that's been mined since early existence. So there are engineered similarities between some cryptocurrencies, particularly Bitcoin and gold. But there are much more differences, I think, than there are similarities.
And for me, I mean, one of the unique things about gold is the diversity of demand for gold and the way it's used very differently by different sectors of the economy and an industry and so on. You briefly touched on some of the more limited uses for cryptocurrency, but I just wondered if you could talk about the diversity of demand for gold, where that demand comes from and how that compares to cryptos.
Absolutely. And I think you've hit on a key point here, Andrew. If you think about the last 10 years, so stripping out the annual changes that we've seen, particularly during the coronavirus, but look over the last 10 years, about 34% of net demand for gold has gone into jewelry. About 7% of net demand goes into electronics, about 41% into investment of different categories, and then I think the final number, 17% into central banks. So that's a real diversity of different applications. And they're also very different applications too. So if you think about the consumer side of it, so jewelry, industrial applications makes up just over 40%. That's very much driven by wealth, by economic activity, by the number of computer chips that people want to buy, by the number of weddings taking place, by the wealth and the income in countries that consume a lot of gold, particularly India and China. If you look at the investment side, though, also about 41%, that's very much driven by other factors. And those factors include fear and uncertainty, inflation, the overall pool of savings around the world, and how that is growing and how fast that's growing. And then finally, the central bank side, different again. It's, central banks buy gold, as I said earlier, because it's a qualifying asset for them when they're reporting their international reserves. But it also has great diversification characteristics that really help a portfolio of central bank assets, just in the same way that it helps a portfolio of assets for other investors. So you really have these differences in demand for gold, and they tend to be strong and weak at different times. So again, if I think about 2020, the first year of the coronavirus pandemic, we saw economies around the world locked down. We saw jewelry demand fall. We saw tech demand fall as destocking was taking place and economies were grinding a bit to the halt. But yet we saw really strong investment demand as investors looked to gold to help protect them.
And so, I mean, there's that unique diversity of demand with different drivers. So some of which you mentioned would be more pro-cyclical, driven by rising incomes and economic confidence. Some is more counter-cyclical, and I guess that's one of the uniquenesses of gold, and means that it performs very differently, and it has a very different role in an investment portfolio. I mean, what is the strategic case for gold in a portfolio, and how does that compare to crypto? You've touched on some of it already, but I just wondered if you could perhaps talk about why an institution in particular, commercial institution or a pension fund, would want to allocate to gold.
Sure. Obviously, the case that we make for gold in a portfolio is a subject of a presentation in itself, but I can summarize it in a few words. The first argument is that of returns. People think gold performs well during periods of crises and maybe during periods of high inflation, and that's been true in the past, but it's not the only story. Gold's delivered returns over the last 20 years, since 1971, when we came off the gold standard, that have been in line with or better than most other asset classes. The second argument is one of diversification. Gold's not correlated particularly well to most assets, and it's uncorrelated to equities most of the time. But what we do find is when US equity markets fall sharply, the correlation between gold and US equities turns negative. In other words, you're now negatively correlated to something which has fallen fast. That's a very useful attribute to have in a portfolio. Gold is liquid, trading about $100 billion a day, and so in line with or better than many other asset classes. So you can get into it, and also you can get out when you need to, which is particularly important. Combining these things together, its liquidity, its returns, its diversification characteristics, adding gold to a portfolio over the last 10 years, and it doesn't really matter what portfolio you're looking at around the world, a typical institutional investment portfolio, adding maybe between 4 and 8% of gold, depending on the portfolio, has increased the risk-adjusted return of that portfolio. Gold is an excellent diversifier. We think pretty much every portfolio should have gold in it for those reasons. Now, if you look at crypto assets, if you do the same sort of analysis, looking at returns and crucially looking at volatility as well, you find that putting crypto assets into a portfolio over the last 10 years has also increased the risk-adjusted return of that portfolio. The ideal weighting for crypto assets comes out as much lower than it does for gold, and that's probably due to the volatility. But yes, it's increased the risk-adjusted return. So you say, well, that's the same as gold, but it's not, because it's done it in very different ways. Gold increases the risk-adjusted returns of a portfolio, typically by contributing a bit to the returns and reducing the risk because of its diversification benefits. Crypto assets have contributed to returns. Returns are good, but they've done it at the expense of higher volatility. So owning crypto in the last 10 years has not been bad, not at all. As I say, it's been a source of good returns, and it's increased the risk-adjusted return of a portfolio. But it's not proving effective diversification. It's like increasing your weighting to equities, particularly volatile, high-growth NASDAQ equities. So it's like really adding a leveraged FANG position to your portfolio, which again worked great over the last 10 years. But understand what you're doing there. You're adding risk to your portfolio. You're not diversifying it through owning crypto assets. Now, it's only been 13 or 14 years, I think it is, since crypto assets have really been out there and people have been trading them actively. So we don't know what these correlations are going to look like in the long term. But at the moment, certainly over the last few years, since I think adoption of crypto assets has grown, they certainly seem to behave more like these high beta US tech stocks than anything else.
Now, you've suggested that there's potentially significant market risk around investing in crypto. There's also a lack of historical data, so I guess the jury's still out in terms of the longer term performance and longer term correlations and so on. But what are the other risks associated with crypto, and how do they compare to an investment in gold?
Well, I guess the first thing that stands out is volatility. Gold is an asset class that has volatility similar to equities, lower than bonds. Everything is lower than bonds, really, but similar to equities and less than individual shares or individual commodities. Crypto assets have volatility which is multiples of that. So we're talking, I don't know, 50, 70, maybe even 100% annualized volatility in crypto assets. So that's your first risk. And that, by the way, is one of the reasons why you end up with a lower target allocation for crypto assets if you run a portfolio simulation, simply because of that high volatility. So that's the first point. I guess the second point is regulation. We've heard a lot from regulators around the world in the last couple of years, from the SEC, from the CFTC, from the FCA in the UK, from the IMF, from the European Central Bank, etc., all talking about the need for a regulatory framework for crypto assets. That regulation is likely to have an impact on valuations of crypto assets as it comes in. And we've seen that to an extent from time to time when there's a new announcement or a new prosecution or fine. There's often volatility around crypto assets. I think the lack of regulation at the moment and the lack of generally safe places for investors to access crypto assets is one of the things that's stopping adoption taking off. And I actually think that once regulation has come in, once the so-called exchanges, online platforms at the moment, become proper exchanges, where they're regulated, where they're supervised, where there's proper AML, KYC, etc., then I think that there may be the potential for crypto assets to become more mainstream. But that doesn't rule out a tremendous amount of volatility in the meantime. There's also tremendous concerns in some elements of markets about the role of stable coins in the crypto environment. So coins such as Tether, I think there's one called Circle, etc., which are supposed to be backed, one for one by US dollars, but seem to be irregularly and incompletely audited, and people are not quite sure, despite some disclosure, what's behind them. So there's a whole chunk of the Twitter sphere that believes that these stable coins are a scam and that they're propping up the whole of the crypto market. And there's a whole an opposing faction on Twitter that believes that that's nonsense, and the stable coins are all fine. But until I think we have better clarity on this in terms of regular audits, in terms of better disclosure, I think that's a risk that lies over the crypto market as a whole.
Now, changing tack slightly, we've just released our H1 outlook, looking at the key themes that are going to be shaping thoughts and minds of investors over the next 6 months at least. Understandably, no surprises, a key theme is going to be inflation. Can gold still be considered an effective inflation hedge? Now, I know we've published quite a lot of research on this in the past, and I'm just interested in what your take is on that.
Yeah, that's right. We've written probably more on the different types of inflation in the last 12 months than we have probably in the preceding 5 to 10 years, which probably makes sense because we haven't really had much inflation prior to the last, say, 12 or 18 months or so. So I would direct people to have a read of those publications, but I would also say I have my own views as well. Gold's come under quite a lot of criticism for its lack of performance in 2021 in light of the increases in inflation that we've seen last year and seem to be persisting into 2022. I answer that in two ways, really. First of all, we saw gold perform really well in 2020. And I think at least part of that performance was in anticipation that the extraordinary monetary policy, the extraordinary fiscal policy that was being conducted to tackle the recessions around the coronavirus would have an impact later on. So to a certain extent, gold anticipated what was going to happen as we came out of the coronavirus recessions around the world. The second way I think about this as well is that the gold market, along with many other markets, is telling us that central banks have got this. We shouldn't worry about inflation. It may not be perhaps as transitory as Chairman Powell said it would be, last year. But I think the expectation is that measured and modest action by the central banks around the world, primarily led by the Fed, will see inflation off. So I think that if that proves to be erroneous, if we do see inflation more persistent and also less controllable, then I think gold may have a second leg higher in terms of its inflation hedging. I think the sweet spot for gold is actually rather a nasty one for the global economy, and that's if central banks struggle to hike interest rates to tackle inflation because of the impact that they're having both on the underlying economy, but also on financial markets. And if we get to the stage where the Fed, after a few interest rate hikes, perhaps this year or maybe into next year, has to reverse tack because of the impact that it's having, and yet inflation remains high, then I think gold could do particularly well.
So that's inflation, which is obviously going to be a major theme for this year. What else should investors be looking out for that could be impacting or driving gold's performance this year?
Well, I think that the most obvious factor is going to be monetary policy, particularly US monetary policy. So we're talking about the Fed. It's going to taper, it's going to hike, it's probably going to go through quantitative tightening as well, so shrinking its balance sheet. Anticipation of all of this in the second half of last year, I think, was responsible for a lack of performance by gold, and also some short-term volatility to the downside. We typically would get some strong US economic data that was making people think that the Fed was going to hike earlier than they expected previously. Gold would sell off and then recover pretty much all of the losses that it had seen. I would expect that pattern perhaps to continue. Work we've done suggests that gold tends to underperform in the 6 months or so before the Fed hikes. And I think most people are now expecting the Fed to hike in Q1 2022. And that perhaps, again, explains some of the poor performance we've seen in gold relative to other assets in the back half of last year and perhaps even the early parts of 2022.
Thanks, John. Final question to bring it back to cryptocurrency. How can gold remain relevant in a digital world?
It's a great question, Andrew, and it's one that, as you know, we wrestle with at the World Gold Council. In a way, it underpins everything that we do. The data we collect, the research we write, the market knowledge that we demonstrate in speaking to investors. All of these things are aimed to keep gold relevant in the 21st century and beyond. And a lot of it is getting the message out about how good gold is in a portfolio, the benefits that it brings. We've been making the case for gold for a few years now to institutional investors with, I'd say, renewed enthusiasm. We're not done yet. We're only, I guess, I don't know, a quarter of the way along that process. So we've got to keep doing that. But I think in addition to making the case for gold to institutional investors, I'm really interested in the prospects of getting gold relevant to younger generations as well. Everybody sees news, social media commentary about crypto assets, and it's filled with it, and all manner of strange and weird and wonderful things like apes and non-fungible tokens and you name it. I'd like to get some of the same buzz, the same excitement about gold. Now, it's going to be tricky. I'll tell you, it's not as obvious a case to get people as excited about gold as it is about some crypto assets. Crypto assets, in theory, people expect them to go to the moon and be able to buy a Lamborghini at the end of the year, and we're going to get 5-fold increase in value. That may happen. It may not. Nobody buys gold expecting it to go up 5-fold, certainly not in the short term. So there is always going to be more potential underlying excitement in crypto assets, particularly when they've gone through a good run, like they have, say, over the last 18 months. But also, if you look at over history, you can see that famine in the crypto space follows feast. So at the moment, I guess it's no surprise that we're seeing people really interested in crypto assets because they've had a decent run since November 2020. But if we are entering a period of protracted weakness, as we've seen in the past, then it might just get a bit quiet there. But it's ultimately, I don't think crypto assets are going away. We don't advocate buying or not buying them. That's not our job. And to be frank, we would not be credible in saying, don't buy crypto assets, buy gold. But I do think that people that get involved with the space really need to understand the risks. And it does concern me that there's a lot of people getting into this space that don't know very much about it at all.
Well, thank you, John. And thank you for watching this World Gold Council webinar. We've talked about a number of World Gold Council reports. Last year, we published a report on gold versus crypto. Just this week, we've published our outlook for the first half of this year, and we publish regular series of reports, including technical reports on gold and inflation, and we have a series of reports looking at gold demand. All of that is available online on www.goldhub.com. All of our research is there alongside an optimization model and also our valuation tool called Quorum. So please do have a look. Thanks again for watching, and this was the World Gold Council.